Welcome to Hibiscus Petroleum's Financial Results Webcast. This webcast presents an overview of the results reported as part of the quarterly financial report for the 3-month period ended 31st March 2018 and released today. This webcast has been prepared by Hibiscus Petroleum Berhad, i.e. the company, solely for general information purposes only and shall at all times be heard and/or viewed together with the full quarterly report for the same period that is made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs, and projections about future events or matters. By listening to and/or viewing the webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. There are 5 parts to this webcast. In Part 1, Pascal Hoss, Chief Executive Officer of C. Hibiscus Sendirian Berhad and a co-founder of Hibiscus Petroleum, will take you through a brief introduction of the company. In Part 2, Deepak Thakur, Group Petroleum Economist and UK JV Asset Manager, will provide an overview of our UK asset, the Anasuria Cluster. In Part 3, Pascal will provide an overview of our second producing asset, the 2011 North Saba Enhanced Oil Recovery Production Sharing Contract. In Part 4, Yip Chi Yong, or CY, Vice President of Finance and Group Controller, will present the financial highlights of the company's third quarter results. Pascal will then conclude with some of our key messages for this quarter in Part 5. Should you have any queries, you may contact our Investor Relations team via the email address provided at the end of this presentation. I shall now hand over to Pascal.
Hello, this is Pascal Hoss. I'm a co-founder of Hibiscus Petroleum Berhad and the Chief Executive Officer of C. Hibiscus Sendirian Berhad. C. Hibiscus Sendirian Berhad is wholly owned by Hibiscus Petroleum Berhad and has recently completed the acquisition of a 50% interest in the 2011 North Saba Enhanced Oil Recovery Production Sharing Contract, or the North Saba PSC. Let me commence this presentation by providing you with a brief introduction about Hibiscus Petroleum Berhad. Hibiscus Petroleum was listed on the main market of Bursa Malaysia in July 2011. We listed with the intention of being a pure-play oil and gas exploration and production company. Initially, our activities were more focused towards exploration, but since 2014, when U.S. shale-related oil production catalyzed a drop in oil price, we have refocused our goals, concentrating the growth of our business by acquiring mature assets that allow us to safely and profitably enhance production in regions of our geographic focus. Our ownership of the Anasuria cluster of oil and gas fields in the UK North Sea, in this regard, is consistent with our goals and has been significant in generating positive cash flow and profit for the company over the past 2 years. Through joint operatorship in Anasuria, the company is also fast gaining valuable operating experience in the UK, as several significant projects have been delivered safely and efficiently. From Anasuria, we produced an annual average of more than 3,500 barrels of oil equivalent net to our company on a daily basis over the financial year ended 30th of June 2017. As of 31st March 2018, we are also the operator of the North Saba PSC. Here we have a 50% participating interest in an asset located offshore the state of Sabah in Malaysia, with Petronas Carigali as a partner with the remaining 50% as its participating interest. For our 50% participating interest in the North Saba PSC, our entitlement of net daily oil production over the calendar year 2017 averaged approximately 5,400 barrels of oil per day. Our vision is to be a respected and valuable independent oil and gas exploration and production company. By 2021, our mission is to secure 100 million barrels of net proven and probable, or 2P, oil reserves and/or entitlement from currently held assets or potential new ventures located in areas of our geographic focus. We are also aiming to achieve net oil production of about 20,000 barrels of oil per day. With the recent completion of the North Saba transaction on 31st March 2018, the group has achieved about 40 to 50% of both our net production and 2P reserves and/or entitlements targets due for delivery in 2021. We anticipate the gap towards fully achieving our mission to be closed by developing identified opportunities within the assets that are already in our portfolio and through new ventures. In respect of new ventures, we will be selective about the opportunities we pursue to ensure that they demonstrate attributes that are consistent with our overall business strategy. Underpinned by a great deal of industry knowledge and experience in our team of people, and our desire to deliver superior performance as part of our organizational work culture, we believe that these targets are achievable. Our current portfolio, consisting of 1 development, 1 exploration, and 2 production assets, is spread across 3 geographical locations, i.e. the United Kingdom, Malaysia, and Australia. Our asset in the UK, where oil and gas interests are held through concession-type agreements, is the Anasaria cluster. It comprises 4 producing fields with total 2P reserves of 22.7 million barrels of oil net to our company as of 1 January 2018. In Malaysia, we recently concluded the acquisition of the North Saba PSC, which is a production sharing type agreement. The North Saba PSC includes 4 producing fields, which altogether contain gross 2P reserves of 40 million barrels of oil. In Australia, we have approximately 6.5 million barrels of 2P reserves located in the Vic L31 West Seahorse development asset. Deepak will now take you through details on the Anasaria cluster in part 2 of this webcast.
Hello, I am Deepak Thakur. At Hibiscus Petroleum Berhad, I have 2 roles. I am the Group Petroleum Economist as well as JV Asset Manager for the Anasaria cluster. I will now take you through some information on our first producing asset, the Anasaria cluster, which is located offshore the United Kingdom. As of 31st March 2018, the company's indirect wholly owned subsidiary, Anasaria Hibiscus UK, has been involved in the joint operations of the Anasaria asset for just over 2 years. The Anasaria asset is located about 175 kilometers east of Aberdeen and has been producing since 1996, with an estimated remaining economic life of approximately 18 years. Our interest in the Anasaria cluster comprises a 50% interest in the Teal South, Gilmore A, and Kite fields. We jointly operate these fields together with our partner Pink Petroleum through a jointly owned legal entity incorporated in the United Kingdom called the Anasaria Operating Company. The cluster also includes the Cook field, and we have a non-operated 19.3% interest in this asset. Included as part of Anasaria cluster are all the installed subsea production infrastructure and the floating production, storage and offloading vessel, the Anasaria FPSO. Taking a closer look at the field layout, the subsea infrastructure underpinning the production of hydrocarbons is quite extensive and spans 25 kilometers from north to south. Our confidence to jointly operate this asset is derived from the existing knowledge and experience of Hibiscus and Pink personnel, some of whom have previously worked in the UK North Sea environment. Operating risks are further mitigated by the fact that we also utilize the services of Petrofac, a reputable international service provider, in the role of offshore duty holder for the facilities and pipeline, whilst AOC is, since early February this year, the designated operator for the offshore wells. During the first year of joint operations on the Anasaria cluster, we focused on understanding the asset, the environment we work in, and most significantly, we relentlessly applied ourselves towards improving operational performance. In our second year of joint operations, we initiated and completed several production enhancement projects of low technical complexity, which we believe has made and will continue to make a positive impact on the performance of the asset going forward. The safe and successful execution of these projects have provided us a base to address the more technically challenging projects, such as the Gilmore P2 sidetrack well, which we will be undertaking over the next couple of months. Over the last 2 years under our joint operational control, multiple milestones have been achieved. For this webcast, however, I would like to review our operational performance, which we track using several key performance indicators as shown in this slide for the period from January to March 2018. In this quarter, we recorded a higher average daily oil production rate of approximately 2,800 barrels a day compared to the average daily rates achieved in the previous quarter. Together with gas exported, our average daily oil equivalent production rate for the quarter was approximately 3,100 barrels of oil equivalent per day. The average uptime for this quarter was 82%, also an improvement from the operational performance of the previous quarter. Generally, the operational performance for this quarter improved significantly when compared to the previous quarter, despite several planned and unplanned events which will be discussed in the next slide. In February 2018, we sold a parcel of circa 271,000 barrels of oil net to the company at approximately $65 per barrel, and this contributed to us delivering another profitable quarter. Given the higher average daily production rate, the OPEX per barrel of oil equivalent metric has also decreased for the quarter to about $24 per barrel of oil equivalent. To recap, the key performance indicators in this quarter versus the previous quarter have all improved. We achieved higher facility uptime of 82%, higher net production rate of 3,100 barrels of oil equivalent per day, and lower OPEX per barrel of oil equivalent of $24 per barrel. While all KPIs showed improvement when compared to the previous quarter, our operational performance was affected by a planned routine maintenance project to inhibit scale buildup in the Gilmore P3 well, as well as two unplanned events. The first unplanned event was a temporary interruption in production from the Gilmore A field due to a temporary failure of our gas compression facility on the Anasuria FPSO, which continued from the previous quarter. The second unplanned event was an unusually adverse weather condition, which caused 2 days of reduced production. These events, however, did not affect our ability to carry out an offtake and sell a cargo of oil. All technical issues have been resolved, and we are pleased to report that wells and facilities are currently performing at the expected levels, and we hope to report even further improvements in our KPIs in future quarterly reports. Over the next few months, our operations team is focused on delivering the drilling of Gilmore P2 sidetrack well safely and on budget. The drilling of Gilmore P2 sidetrack is expected to commence in early June 2018 and last approximately 2 months. As announced in our press release of 7th of February 2018, our jointly controlled operating entity, the Anasuria Operating Company Limited or AOC, had awarded a drilling rig contract to Seadrill for the provision of its 6th generation semi-submersible drilling rig, the West Phoenix. This rig has been contracted to drill Gilmore P2 sidetrack well into the Forties reservoir as the primary geological objective, or the Fulmar reservoir, which is a secondary target. By using the existing Gilmore P2 well as a donor well for the sidetrack, we hope to be able to realize enhanced crude oil production as soon as the drilling program is completed around the middle of the calendar year 2018. This project is also forecasted to realize net 2P reserves of 1.01 million barrels undrained Attic oil. The drilling of this sidetrack well is part of our overall strategy to enhance production from the Anasuria cluster to up to 5,000 barrels of oil per day by the financial year ending 2020. I will now hand you back to Pascal to provide a brief recap on our recently acquired 50% participating interest in the North Saba PSC.
In October 2016, we announced that C. Hibiscus Sendirian Berhad, a wholly owned subsidiary of Hibiscus Petroleum, had entered into a conditional sale and purchase agreement with Shell. This transaction entailed the acquisition of Shell's entire 50% participating interests in the 2011 North Saba Enhanced Oil Recovery Production Sharing Contract. The SPA also included interests in the joint operating agreement between Shell and Petronas Carigali in relation to the PSC. This transaction provided Hibiscus Petroleum with its first asset in Malaysia, and also marked our second deal with Shell internationally. On 31st March 2018, C. Hibiscus successfully completed this deal and thereby came untitled to the PSC. On the same date, we also became a partner and operator under the joint operating agreement. The North Saba PSC has been producing since 1979 with production rights until 2040. The deal includes the operatorship of 4 producing oil fields offshore Saba, namely St. Joseph, South Furious, SF30, and Barton, as well as the operatorship of the Labuan crude oil terminal and all other equipment and assets related to the PSC. The 2P reserves for this asset, based on 100% interest in the PSC, is 40 million barrels through 2040, the end of the PSC life, as reported in the Annual Review of Petroleum Resources report as of 1st January 2018. Our independent valuation, performed by Risk Operations Private Limited, estimated the asset to hold 79 million barrels of contingent resources, also based on 100% interest in the PSC. Consequently, we believe this asset holds a great deal of potential. As resources are channeled towards identified future development opportunities, subject to capex and oil price, the 2C resources may be exploited to unlock further value. To recap, the total purchase consideration for the acquisition of Shell's interest in the North Saba PSC was $25 million. The purchase consideration was arrived at on a willing buyer, willing seller basis, and after taking into account, amongst others, the expected economic benefit to be derived from the effective date of the SPA, which was 1st January 2017. There are 2 main components of the purchase consideration. The first component is the initial consideration of $15 million, which was fully settled in April 2018. The second component is the deferred consideration of $10 million, which is due in 2 tranches of $5 million each, on the first and second anniversary of the completion date. The table shows the operational performance of the North Saba asset over the 5 quarters from the effective date to the completion date. During this time, Shell was operating the North Saba asset on behalf of sea Hibiscus. The performance of this asset has been steadily improving in terms of the average production rates, uptime, and realized oil price. We wish to highlight that the average oil price realized includes the premium that Labuan crude oil commands over Brent. There are several opportunities to unlock value within the North Saba PSC. The immediate focus of our efforts will be to continue ensuring a seamless integration of the North Saba operations with our existing work processes and performance-based operating culture. Going forward, we also aim to enhance production rates, manage costs, and improve uptime of the asset, thus optimizing the OPEX per barrel metric. We will look towards identifying and implementing opportunities for production optimization and enhancement via surface and subsurface activities in the near term. All in all, we are pleased that the completion of the North Saba transaction proceeded as planned. The group now has 2 producing assets in different geographies, each delivering positive cash flow against a backdrop of strengthening oil prices. Slowly but surely, we are strengthening the group's technical and operational capabilities, building balance sheet resilience and steady earnings growth. We hope our efforts will continue to enhance stakeholder value. I will now pass you on to CY, who will take you through the impact of the acquisition of the North Saba PSC to group financials and other highlights for the quarter.
Hi, I'm CY, Vice President of Finance and Group Controller, and I'll take you through the financial highlights for the quarter. Before we proceed to review the financials for the quarter, I would like to present some key factors that can affect the financial performance of our assets. Firstly, we are exposed to movements in oil and gas prices, particularly Brent crude oil price at the time of a scheduled offtake from the Anasuria FPSO or the Labuan crude oil terminal. In this regard, we have seen gains in Brent crude oil prices which are expected to be sustainable over the near term for several reasons. This being, OPEC and its allies strictly complying to agreed production quotas as a means of managing oil prices. Strong global oil demand, particularly from China and India. Geopolitical tensions in the Middle East. Reinstitution of sanctions by the US on Iran. And production shortfalls in Venezuela. More significantly, a prolonged period of minimal investment in exploration and development projects over the recent years of low crude oil prices is also a factor that has resulted in higher oil price trends. Another factor that impacts the performance of Anasuria and the North Saba PSC relates to foreign exchange rates. These play a role as we recognize our revenues and the valuation of the Anasuria and North Saba oil and gas fields in US dollars, while the bulk of our operating costs are incurred in sterling pounds for Anasuria and in Malaysian ringgit for North Saba. Additionally, as a Malaysian listed company, we ultimately report our results in the Malaysian ringgit. We are unable to control the previously mentioned macroeconomic factors, so instead, we focus our efforts at business drivers that we can control. Thus, we manage the production performance of the wells, facilities uptime, and operational costs related to the Anasuria and North Saba assets to the best of our ability. As presented by Pascal in Part 3 of this presentation, the group completed its acquisition of a 50% participating interest in the 2011 North Saba EOR PSC on 31st March 2018. The provisional fair value of the North Saba asset as at 31st March 2018 has been reviewed in accordance with the provisions of MFRS 3, Accounting for Business Combinations. The initial fair values of assets and liabilities recognized on acquisition have been updated to reflect the working capital adjustments and decommissioning provisions. This resulted in a fair value gain, referred to in the quarterly report as a negative goodwill from business combination, of 112.4 million ringgit, which is recorded in the profit or loss statement. We wish to highlight that, as permitted by MFRS 3, the allocation of purchase price can be finalized up to 1 year from the completion date to determine the fair values of acquired identifiable tangible and intangible assets and liabilities. Thus, our determination of fair value gain may be adjusted in the future. In the set of results for the third quarter ended 31st March 2018, we have included the North Saba asset as an operating segment. Earnings before interest, tax, depreciation and amortization, or EBITDA, of the North Saba asset was reported at approximately 90 million ringgit. This was due to the provisional fair value gain of 112.4 million ringgit, which was partly offset by transition costs in connection with the acquisition and segment-specific administrative expenses of 22.8 million ringgit. As there is no tax associated with North Saba in the quarter, the profit after tax for this asset was also approximately 90 million ringgit. As for the Anasuria segment, the EBITDA reported was about 35 million ringgit, representing a marginal increase to the number reported in the previous quarter. Anasuria's EBITDA margin of 47% this quarter is fairly consistent with the previous quarter of 46%. As can also be seen, the Anasuria segment contributed a profit before tax of 20 million ringgit and a profit after tax of 22 million ringgit for this quarter. We wish to highlight that when there is a period with high investment in capital expenditure in the UK, the deferred tax charge, which is non-cash, will likely be relatively high. However, UK tax regulations grant us an immediate tax income relief equivalent to total capital expenditure against taxable income. Whilst profits are extremely important, management's focus remains on delivering strong and sustainable EBITDA levels, as long-term business continuity is of the highest priority. Over the past few quarters, our balance sheet has been gradually strengthening, more so with the introduction of the North Saba asset as part of the group's overall business portfolio. We have built our total assets to approximately 1.6 billion ringgit and shareholders' funds to 866 million ringgit, representing an increase of 27% and 11% respectively from the previous quarter. In addition, as at 31st March 2018, the group's cash is at a healthy 109 million ringgit, which includes proceeds from the Anasuria crude oil offtake in December 2017. The restricted cash recorded in our results relates to a security for our portion of the estimated cost of decommissioning the facilities of the Anasuria cluster. We are required to periodically place monies in a trust commencing 18 months from the completion date of the Anasuria cluster acquisition until such time that the security has been fully provided for. one such placement of funds amounting to 7.2 million ringgit was made during this quarter. We would also like to highlight that our net current assets position has continued to improve to 199.9 million ringgit compared to 42.3 million ringgit in the previous quarter. Whilst the group has remained debt-free, we anticipate that we shall put in place a certain quantum of debt facilities to ensure that production enhancement projects and opportunities we have in hand may be executed smoothly. Subject to being successful in establishing such debt facilities, our intention is to limit borrowings to a conservative level of gearing. Before we wrap up, I would like to pass you back to Pascal to highlight a few takeaway points.
The group is focused on delivering its 2017 to 2021 business objectives. Several milestones have been achieved by the group in the third quarter of our financial year. First and foremost, we successfully concluded the North Saba acquisition as scheduled on 31st March 2018. Second, and no less important, trading of the company's warrant C commenced on 28th March 2018. The closing price of the warrant C on 25th May 2018 was 50.5 sen, translating to approximately a gain of 10 sen per Hibiscus share based on the original warrants distribution terms for those shareholders who were awarded the warrants and continue to retain them. Over the next few months, we look forward to drilling of the Guillemot P2 sidetrack well and hope to realize the associated incremental production in the first quarter of the next financial year ending 30th June 2019. We also hope to continue to improve the uptime of the Anasaria assets. In the North Saba asset, we will continue to work relentlessly to integrate North Saba operations into the group and will also work towards reducing unit production costs. The completion of the North Saba transaction has boosted our net entitlement of production and 2P reserves to within the range of 40 to 50% of our 2021 mission. We anticipate the gap to be closed by developing identified opportunities within the assets that are in our portfolio and also through new ventures on a selective basis. We hope all these events will act as positive value-enhancing triggers for our shareholders.
And that's all we have for this quarterly earnings webcast. Thank you for tuning in.